Tyler, if you were to read some of the headlines, it would seem like there's a major CEO shakeup happening over at Hershey. The CEO is leaving. It's been announced that she's going to be leaving the company. You ready to talk about the implications, what it means, and kind of where the reality is versus maybe the perception?
Yeah, it's funny. Hershey's one of those companies that's never been in the news, but all of a sudden, the past 6 months, it seems like Hershey's getting a lot more headlines than they're typically used to.
We're going to get to the bottom of it. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, check out our special link. It's fool.com/unscripted. Go to fool.com/unscripted. You can get access to The Motley Fool's 10 best stocks to buy right now. Hershey's, we do need to unpack what's going on. So, what happened?
I think it's kind of a combination of many, many things. We can talk about the business side. We can talk about the finance kind of investing world side of yield and demands on dividends and slow growth versus fast growth companies. There's a little bit of M&A intrigue. I mean, it goes in a lot of different directions. So let's kind of talk about the business. It's sweets and chocolate and some salty snacks, and it's not exactly the fastest growing business. When you're buying like these consumer staples, snack food companies, they're pretty slow growth businesses. And the idea being that they're going to manufacture higher earnings through raising prices, using your free cash flow to buy back shares, to, make your per share value increase, pay you a dividend. And, you're not typically not buying something like Hershey or some of its competitors as a go, go, go beat the market kind of stock. It's more of a stable, growing dividend, probably not a whole lot of downside risk associated with it. That's kind of been the case. There was a recent Wall Street Journal article that was talking about the retirement of Michelle Buck. The ending line was kind of brutal. It says Hershey shares have gained about 46% since Buck took over in 2017 versus 147% gain for the S&P 500. So it's been a pretty slow growth business. Yes, it's made some money for its investors, but you can't exactly get excited about the returns.
The market slapped it twice, right? I think that's just if you really get to the
Yeah.
core of it. Yeah.
And then, there's also the component of what people value things for. We've talked off and on, either offline or online, about the idea of you know, people should kind of demand more of slow growth businesses, or at least value them differently today in a world where a US Treasury yields 4 to 5%. That's a much safer asset than owning stock. And if you can get that kind of yield from something like that, maybe you don't want to pay for a slow growing consumer good company with a dividend yield of like 2%. You probably want it to be higher. And that's going to make the stock go down. And I think those things, some cocoa prices going really wacky in the past couple of years. Mondelez tried to acquire Hershey, but Hershey knocked it down. So there's been a lot of stuff in the news lately. And perhaps that's why we're seeing these stories about Michelle Buck retiring. If Hershey was just doing swimmingly, kind of going about business as usual, probably wouldn't have even made the news wire. But because
Mm.
of it, because of the recent storiness or the newsworthiness of Hershey, it's kind of gotten a little bit more headlines than some might expect.
Here's the numbers. I'm going to start with gross margin. And we see the gross margin more recently, it's taken a hit as the costs are hitting the business. Cocoa for sure, but at the same time, revenue has started to decline, which means that consumer demand is starting to weaken. When you see your gross margin and your revenue both come down, it's going to double whammy you on the bottom line. And we see earnings have come down over the past nearly a year. The stock price has also come down substantially for those reasons and also for reasons of competition. There was a short report, I think about a year or so ago, and you put all those things together and it paints a picture that's not necessarily great for the business, but the business continues to be healthy, if not as healthy as it was, say, 2 years ago. Put all those things together, and there's a lot of attention that's being paid to this, Tyler. Thinking about the situation and the reality of what's going on, how do you think about the business? Is Buck being forced out? Is it time for a leadership change? Or does this feel maybe more just like business as usual to you?
It sounds a little bit more like just business as usual, getting more attention than probably expected. I think maybe some of the things that they have done have been a little, not quite up to snuff. We're clearly at a point, I think, in snack foods in general, where a lot of things are looking a little stale. It's just not a case of Hershey. I mean, the reason Mondelez was courting it too was because Mondelez has been a little stale. And if you look across a lot of these snack companies, they're not doing so hot. And so they're trying to consolidate in some ways, either to like command pricing power or to put more leverage against buying cocoa prices, being a little bit more efficient there. It's all just trying to like squeeze things out at the margins for what has become a relatively sclerotic growth industry.
I think that's probably the case. So let's unpack everything that's actually happening with Michelle Buck and objectively look at it without some of the bombast that we've seen that maybe makes it seem like she's being pushed out the door or there's major change happening. First of all, she's retiring in June of 2026. So we're talking a year and a half from now, essentially, is the plan. So to me, that feels a lot like just normal corporate succession planning where you take your time, you're in a position where you don't have to rush. You can find the right next CEO. Maybe there's an internal candidate that turns out to be the right fit. Michelle Buck has been there for 20 years. She's been the CEO for 7 and will have been this about it, coming up on 8 years as CEO now. Will have been the CEO for 9 years when she leaves. The average S&P 500 CEO tenure is like 5 years or less. So she's already been in charge for a long time. And I think part of that, Tyler, is the controlling entity that really controls Hershey is the Hershey Trust that has super voting shares that essentially give it voting control of the company. And my assumption is that the people that are running the trust want continuity and stability more than absolutely anything else. The goal is not to make this some mega winner. It's to generate consistent, steady cash flow that it can pay a stable dividend and grow that dividend in modest amounts over time because the trust pays for things like the Hershey School and other charitable things that it supports. So continuity is vastly important here. Buck, in an interview with the Journal, said that she's been talking with the board for years about succession planning and has maybe stayed longer than she initially had planned to at this point already, but did say that there are things that she still has to do before she's going to be ready to leave. So I think this is just really good, normal succession planning, not necessarily some major shakeup, but let's sprinkle a little bit of reality seasoning here. Everything you talked about with the industry, and now we think about with the GLP-1, GLP-1 medications as this overhang that could substantially affects consumption of snack foods and sugary foods over the long term. I don't think it's like an imminent threat for the industry, but it could certainly affect it over the long term and slow consumption. It's probably is a good idea to get fresh eyes and maybe have a little bit of a shakeup because sometimes somebody new coming in gets a little bit more room to do things differently than somebody that was at 7 years as the chairperson and CEO. So maybe it's a little bit of two things that maybe are both a little bit true at the same time. Let me ask you this last question before to wrap this up, Tyler. Looking at Hershey right now, it's a business going through a little bit of a turnaround. The weakness we've talked about, dividend yields well over 3.5% at this point. Is there anything about Hershey that you think is compelling as an investment?
From a valuation standpoint, it looks a lot better that it did. But for all the things that we just said, it sounds like it's a pretty slow growth business, right? And for a slower growth business that it is, based on where I am in my investing life, I'm still looking for a little bit, despite all of the times that I sit here and curmudgeonly talk about value, I do want a little bit more growth than I think what Hershey has to offer in the coming years. If that yield was considerably higher, or if it was trading for a much more significant discount, we could talk. But it's one of those things where I feel like I would need to be overwhelmed from a valuation standpoint before I would want to do this. Not to say anything too disparagingly of the business. I think it's a solid one that is going to continue to do what it does. But I don't necessarily see paying at the price that it has for a 3.5% dividend. I feel like I can find better dividend yields elsewhere.
I'll counter a little bit and say that I think that 3.6% yield is compelling when you think about the dividend growth. Consistent, very above average dividend growth. The last dividend increase was about 14%. So I think you're going to get substantially higher dividend increases than you might get at other companies where you might earn a little bit higher yield. If you're looking for a good long-term investment that can grow your yield on your cost basis over time by growing the dividend at a high rate, I think the floor is pretty low too. I think it should be a pretty safe investment over the long term. I think you hold it over 10 years, get that dividend growth that, again, I think the Hershey Trust prioritizes in the strength of the business. They're going to beat the market. I mean, if we see a massive rebound in the business and the valuation goes up, sure, probably not a market crushing stock from here, but probably does a little bit better than owning bonds over the long term because of the total return potential that you can get from here. So if you're looking for something that's kind of in between, fit in a lot of people's portfolios.